The Intelligent Investor. Benjamin Graham's timeless masterpiece is a beacon of knowledge, guiding investors through the treacherous waters of the financial world. Whether you're a novice or a seasoned investor, this book holds invaluable lessons that will revolutionize your approach to investing. So, gather around as I present to you the important lessons from The Intelligent Investor. Chapter 1: Investment versus Speculation. In the opening chapter, Graham distinguishes between true investment and speculative activities. He emphasizes the importance of approaching investing as a business owner rather than a gambler. Graham teaches us that investing should be based on careful analysis, valuation, and a margin of safety, rather than relying on predictions or short-term market fluctuations. Chapter 2: Mr. Market and the Margin of Safety. Graham introduces us to the character of Mr. Market, an allegorical figure who represents the stock market's fluctuating moods. He warns investors against being swayed by Mr. Market's whims and advises instead to focus on the intrinsic value of investments. Graham stresses the concept of the margin of safety, which suggests that investors should only purchase securities when their market price is significantly below their intrinsic value, thus protecting them against potential losses. Chapter 3: The Defensive Investor. In this chapter, Graham outlines his philosophy of the defensive investor, one who prioritizes capital preservation and seeks a reasonable return with minimal effort. He advises defensive investors to diversify their portfolios by investing in a mix of stocks and bonds. Graham introduces the concept of dollar-cost averaging, where investors regularly contribute a fixed amount of money regardless of market conditions, effectively buying more shares when prices are low and fewer shares when prices are high. Chapter 4: The Enterprising Investor. Building upon the defensive investor approach, Graham discusses the enterprising investor, one who is willing to dedicate more time and effort to achieve better returns. He introduces the concept of value investing, which involves analyzing individual stocks to find those trading at a significant discount to their intrinsic value. Graham emphasizes the importance of conducting thorough research, including financial analysis and understanding the business fundamentals before making investment decisions. Feel free to leave a like if you want more content like this. Chapter 8: The Investor and Market Fluctuations. Benjamin Graham explores the inevitable reality of market fluctuations and provides valuable insights on how investors should approach them. Graham emphasized the importance of maintaining a long-term perspective and making investment decisions based on fundamental analysis, rather than reacting emotionally to short-term market movements. Graham begins by acknowledging that market fluctuations are a natural part of investing. Prices can swing wildly in response to various factors, such as economic conditions, investor sentiment, and geopolitical events. He cautions investors against trying to time the market or make investment decisions based on short-term fluctuations, as this approach is often driven by emotions rather than sound analysis. The author introduces the concept of Mr. Market, an allegorical figure representing the stock market's daily price quotations. Graham compares Mr. Market to a business partner who offers to buy or sell shares at different prices each day. He highlights that Mr. Market's mood swings should not dictate an investor's decision-making process. Instead, investors should focus on the underlying value of the securities they own and consider buying or selling only when the price significantly deviates from the intrinsic value. Graham advises investors to adopt a rational and disciplined approach to investing. He emphasizes the importance of conducting thorough fundamental analysis to determine the intrinsic value of securities. By valuing stocks based on their underlying business performance and financial metrics, investors can make informed decisions about whether to buy, sell, or hold their positions. The author also warns against succumbing to the herd mentality that often pervades during market booms or crashes. Graham advises investors to remain independent thinkers and resist the temptation to follow the crowd. He encourages investors to focus on individual securities rather than market trends, and to take advantage of the market's occasional mispricing opportunities. Graham stresses that investors should view market fluctuations as opportunities rather than threats. He suggests that investors with a long-term perspective can benefit from buying quality stocks when they are undervalued and selling them when they become overvalued. By doing so, investors can capitalize on the market's tendency to eventually correct mispricings, generating profits over the long term. Chapter 8 highlights the importance of maintaining a rational and disciplined approach to investing amidst market fluctuations. By focusing on the underlying value of securities, avoiding emotional decision-making, and taking advantage of mispricings, investors can navigate the ups and downs of the market with confidence and increase their chances of long-term success. Chapter 14: Stock Selection for the Defensive Investor. Benjamin Graham outlines key principles and criteria that investors should consider when constructing a portfolio that aligns with their conservative investment approach. Graham starts by emphasizing the importance of diversification for defensive investors. He advises spreading investments across a range of stocks to mitigate the risk associated with individual securities. Diversification helps to reduce the impact of any one company's performance on the overall portfolio. The author suggests that defensive investors focus on large, well-established companies with a history of stable earnings and dividends. These companies tend to have a solid track record and are less susceptible to extreme volatility. Graham believes that such companies offer a higher degree of stability and are more likely to weather economic downturns. Graham introduces the concept of a dividend record as an important criterion for stock selection. Defensive investors should prioritize companies that have consistently paid dividends over a significant period. Dividends provide a tangible return on investment and can contribute to the investor's overall income stream. The author advises defensive investors to avoid speculative stocks or companies with excessively high price-earnings ratios. Speculative stocks often lack a solid financial foundation or have uncertain prospects, making them riskier investments. Graham encourages investors to prioritize quality and stability over potential short-term gains. Graham also introduces the concept of the margin of safety in stock selection. Defensive investors should focus on buying stocks that are priced significantly below their intrinsic value. This approach provides a cushion against potential losses and increases the likelihood of favorable returns. Additionally, Graham suggests that defensive investors consider investing in index funds or exchange-traded funds as a way to achieve broad market exposure and diversification. These funds passively track specific market indexes, allowing investors to participate in the overall market's returns. Chapter 14 provides practical guidance for defensive investors in selecting stocks. By focusing on large, stable companies with a history of dividends, avoiding speculative stocks, seeking a margin of safety, and considering index funds or exchange-traded funds for diversification, defensive investors can construct a portfolio that aligns with their conservative investment approach and enhances their long-term financial success. Chapter 20: Margin of Safety as the Central Concept of Investment. Benjamin Graham presents this concept as the cornerstone of intelligent investing, emphasizing its significance in protecting investors against unforeseen events and market downturns. Graham defines the margin of safety as the difference between the intrinsic value of a security and its market price. In essence, it represents the cushion that allows investors to withstand adverse circumstances and potential losses. By purchasing a security at a price significantly below its intrinsic value, investors establish a margin of safety that protects them if their analysis or projections prove to be overly optimistic. The author stresses the importance of conservative investment practices and advocates for a margin of safety in all investment decisions. Graham advises investors to focus on the preservation of capital and to approach investing with a mindset of minimizing risk rather than maximizing returns. He warns against speculative behavior and encourages investors to prioritize the protection of their principal above all else. To implement the margin of safety concept, Graham suggests conducting thorough analysis of securities, including financial statements, industry trends, and competitive positioning. By diligently assessing the fundamental value of a security, investors can estimate its intrinsic worth and determine whether it is trading at a significant discount or premium to that value. Graham also highlights the psychological benefits of the margin of safety. By purchasing securities with a margin of safety, investors can maintain a sense of calm and confidence, even during times of market turbulence. They can withstand temporary market fluctuations and potential setbacks, knowing that they have already factored in a margin for error. Chapter 21: The Investor and His Advisors. Benjamin Graham recognizes the importance of seeking guidance and expertise, but he also highlights the need for caution and careful evaluation when selecting financial professionals to work with. Graham begins by acknowledging that many investors turn to advisors to navigate the complexities of the financial markets. However, he emphasizes the inherent conflict of interest that can exist in this relationship. Advisors may prioritize their own interests, such as earning commissions or fees, over the best interests of their clients. This misalignment of incentives can lead to biased recommendations and potentially detrimental investment strategies. To protect themselves, Graham advises investors to thoroughly vet any financial professionals they consider working with. He encourages investors to conduct extensive research, seek referrals, and ask probing questions to gauge the advisor's qualifications, experience, and integrity. It is crucial to ensure that advisors align with the investor's investment philosophy and values, and that they have a track record of acting in their clients' best interests. Graham also emphasizes the importance of the fiduciary standard in the advisory industry. A fiduciary is legally bound to act in the best interests of their clients and must prioritize the client's welfare above their own. He suggests that investors should seek out fiduciary advisors who are ethically and legally obligated to provide unbiased and objective advice. Additionally, Graham advises investors to take an active role in their own financial education. By understanding the fundamentals of investing, investors can better evaluate the advice they receive and make informed decisions. While advisors can provide valuable insights, ultimately, it is the investor's responsibility to ensure their financial well-being. The intelligent investor provides invaluable insights for investors seeking to navigate the complexities of the financial world. From distinguishing investment from speculation to understanding market fluctuations and selecting stocks with a margin of safety, Graham's lessons equip investors with the tools and mindset needed to succeed in the long term. By adopting the principles outlined in this book, you can transform yourself into an intelligent investor who approaches the markets with knowledge, discipline, and a focus on long-term wealth creation. So, dear friends, I implore you to embark on this enlightening journey through the pages of The Intelligent Investor and unlock the secrets to financial success. If you're still here, I advise you click on the other wealth-building video on your screen. Thanks for watching.